If someone offered your business $50,000 today, no credit check, no waiting, no hassle, sounds like a great deal, right? But what if I told you that you would have to pay $70,000 back in just a few months? Is that still a good deal? Today, we're going to dive into merchant cash advances and what they are and whether or not they are actually a good deal for your business.
Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it.
A few years back, I was working with a restaurateur to help him get his business off the ground. My private lender had asked me to step in and help him because he was worried about whether or not the guy was going to make it. He way overspent during build out of the restaurant, which caused him to be a little bit cash strapped when he finally got to opening, which is an unfortunate position for a business owner to be in. And side note, also why I advocate for buying an existing business rather than trying to start from scratch, because things always spiral out of control. The guy opened up, started out great, customers coming in, things look good. But because he started from behind the eight ball, cash flow wise, he was struggling. And he decided, against my advice or without even asking me, to go and take a merchant cash advance. This is a quick loan that credit card processing companies typically offer businesses after a little while because they can see how much money is coming through the business every day in the form of credit cards. These sound like a great opportunity for a struggling business. They don't have to deal with a bank. They don't have to do applications. They don't have to go through hoops and hurdles to try to get access to funds. And nobody really cares about the overall health of their business. They just have to show, and the credit card companies can see, that they're taking credit cards on a regular basis. So it sounds like a great deal. Get cash right away, no hassle, no headache. But is it? Backing up a step, a merchant cash advance is not actually a loan. It's in cash advance. You're essentially selling your future cash flow or your future receivables to the merchant processing company. In return for them giving you that cash up front, that advance, they're charging you fees. And those fees can range quite a bit depending on the overall health of the business, or not really the health of the business, but the type of business it is, or the quality and consistency of the credit card sales that are coming through. Those fees can range anywhere from a couple percent up to 40% or even higher. And because they're not a loan, it's not really regulated like the banking industry is. When the merchant cash advance company says, okay, we'll give you $50,000 today, tomorrow. The business owner thinks that's great. And then the merchant cash advance company says, in return for that $50,000, you will pay us back $70,000 or $65,000. It's a big fee, but because the business owner doesn't have to pay it back all at once, it doesn't seem as painful to them. So what the company then does is they take a percentage of the credit card sales every day to help pay down that advance. So they're collecting an additional $15,000 in fees for that $50,000 as an example. Again, the business owner doesn't really feel that pain as much because it's just coming out in small increments every day instead of big monthly payments or a big chunk at the end. The twist here is that $15,000 is a lot of, it's a pretty hefty fee. That's a 30% fee. 15,000 divided by 50,000 is 30%. So when you're comparing that to maybe a credit card at 24 or 25 or even 30% annual rate, on the surface, it doesn't seem that terrible. However, the thing with the merchant cash advance is, are you paying them back every day? And so the company might actually get all of their money back in less than a year, and usually they will. So let's just say you pay that $65,000 back in 6 months. That 30%, the $15,000, which was a 30% fee, actually becomes a 60% fee, 60% annual rate if we're comparing it to an annual rate, because 30% was the 6-month payoff. So 60% would have been the annual payoff. That's a pretty hefty rate when you compare that to other options out there. The other aspect of it is that those daily hits to the credit card processing can really put the business owner into a struggling position as well. Take that restaurant, for example. If they're ringing up $1,000 of credit cards every night, but now instead of getting that $1,000 in a day or two, they're only getting $700, $800 every day, that's really going to put them in a bad position. They still have food costs. They still have to pay the food vendors. They still have payroll. They still have rent. They still have utilities to pay. So now they're getting less money every day. And if they used that advance to pay off old bills, they're going to get behind the eight ball again if they can't keep up with the new current bills. It really kind of starts putting a pinch on the cash flow unless it's a super profitable business from the get-go. A lot of times what business owners do is then they start looking for more sources of funds to help cover other bills. They might take another advance and then start paying even more again. So these things can lead to spirals. And that's exactly what happened with the restaurateur that I was working with, is one led to another one, until eventually he just couldn't keep up anymore. And a lot of times the business owners don't even realize it's happening because the way that these these advances are pitched make it sound like it's not going to be painful and that it's easy and that they're going to have the money today, which is what they usually want or need for their business to survive, but it's not a viable long-term solution. Now you might be thinking, what's wrong with these merchant cash advance companies? Why are they so predatory? Why are they taking so much money? Well, as I just explained to you, there's a pretty big risk. The businesses that are taking these are usually not in great position, and some of them will tend to go out of business. So for every 10 of these advances that a company is giving, they might have one that they can't collect on at some point. So they need to hedge their bets. They need to kind of cover themselves. I mean, they're a business as well. So if they don't ever get their money back, then they wouldn't be in business either. Yes, it might sound extreme, but they are giving a lifeline to business that might not otherwise get it, and then they have to protect themselves from the downside risk. That said, there might be times when it does make sense for a business to do this, despite the high fees, as we talked about. There might be certain situations, whether seasonal fluctuations, which hopefully the business is planned for, or unexpected, road construction right in front of your business that is only going to last a couple months. It really puts a short-term damper on your cash flow, but things will bounce back as soon as that's done and get you back up to the level that you were at. Those types of situations might be okay to do these merchant cash advances, but as a business owner, you really need to be careful. You really need to understand the numbers and the total amount of fees that you're going to pay. Because again, the faster you pay it down, the higher your the equivalent annual percentage would be that you're paying. Ironically, it doesn't make sense to pay them as fast as possible, since that just equates, since it's a fixed fee. You're paying the same amount no matter how fast you pay it. It doesn't matter if you pay it in a month or a year, you're paying the same amount back. But if you pay it in a month, you're actually paying a higher percentage. It gets kind of complicated, but trust me on that. If you're going to do it, make sure you really, really understand it. Make sure you understand the total amount of fees, and make sure you've explored other options before you do it. I know one of the big advantages of these is that it is quick. You can get the money in as little as a day or two. But talk to your bank about a line of credit. So if you are profitable or close to profitable and you have good revenue and something like a road repair is coming up, a bank might work with you on a line of credit for that short-term period. Lines of credit give you a lot more flexibility. You can take money out, put money back in, so you don't pay interest unnecessarily. And you don't get penalized for paying it off faster. You're actually saving yourself money by paying it off faster. A term loan from a bank. So instead of a line of credit where you go in and out of, you can get a fixed 5-year note where you're going to make regular monthly payments for 5 years with a fixed interest rate. Sometimes you can even get it where you don't pay prepayment penalties. So if you're able to pay it down faster, you can pay a little bit less interest over time. Short-term working capital loans from private lenders. There's other lending companies that advertise out there a lot. Some of them charge really high fees or interest rates, and they might take a little bit longer than merchant cash advances. But in theory, they should be a little bit lower of rates because they're going to vet your business a little bit more carefully and not just rely on the credit card sales. Even sometimes credit cards could be cheaper than a merchant cash advance. If you have good personal credit, your small business, you still could get a small business card for an introductory low rate of 0% or a couple percent. Or even if you have to pay 15, 16, 18%, like I just explained, that might be a lot cheaper than paying the equivalent of a 60% or higher annual percentage rate on a merchant cash advance. So make sure you really understand all of the options that are out there before you jump into a merchant cash advance situation. They do have the time, but very, very rarely. So if you're ever offered one, which if you've been in business or you're going to be in business, you will be offered them pretty constantly. They're kind of relentless. They're just hoping that they get you on the right day at the right time. Make sure you stop, do the math. Ask yourself, are you solving a temporary problem or are you signing away all of your future cash flow? Think long term. Build the kind of business that can fund itself going forward. And if you get behind by taking one of these merchant cash advances, it's going to be harder to build that nest egg for the future. Hope this helps understand merchant cash advances. I know it's a pretty complicated subject, and I know there are probably people that disagree with me on them. So let me know in the comments. Hit me up on YouTube, Instagram, Threads, wherever you'd like to. Let me know what you think of merchant cash advances, whether you've used one before, what your experience was. Was it a good one? Was it a bad one? Really appreciate hearing that. If you enjoyed this content, would really appreciate if you could hit the subscribe button. That helps us wherever you're watching or listening right now. And look forward to seeing you again soon. Thanks very much. Talk to you again soon. Cheers.
Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.